Of Millennial Money Matters with Kelly Turner.
And Derek Mazzarella.
Derek, how you doing today?
Fantastic. How are you doing?
Friday.
Friday.
We're recording this on a Friday. It's almost nice out.
Yeah, March Madness is happening, which I'm sure you're really into.
Oh, is it? Is that?
I'm sure you have 13 brackets.
Okay, so I do have 2 brackets.
Oh, look at that. You have more than me.
I have 2 brackets. Both of them are only because there's prizes involved. So I don't even know what happens. I just check every day to see if I'm closer to the prizes.
You're probably going to win too because you're like, oh, bluebirds and blah, blah, blah.
Yeah, I don't. Yeah. I just make a believe. I don't do anything good. I just make believe it.
I probably watch the least amount of college basketball this year than any other year.
Really?
So I have no idea what's going on.
I don't watch any college basketball, but you know what I do watch?
What's that?
A lot of Little League.
Oh, yeah.
You know what starts next week?
Little League, baby.
Little League season. I feel like it's crazy because we've talked about Little League on the podcast before, but it's been like a year, like here we are, we're back again. It is spring. Yeah. That for me is like spring has officially started when I have to sit on a muddy, cold field on all of my Saturdays.
Yeah. The first couple of weeks of practice are rough. You're really cold.
You're really cold. And it's like still kind of dark because practice is, and I don't know if you saw. So if you don't know, Derek and I, your oldest and my youngest are the same age.
Yeah.
So they are playing in the same part of Little League, whatever. And like the practices moved back. Did you see the new times?
No.
Yeah.
They're later now?
They're till like 7:15.
Cool.
And that is like a rough go in our house because my son is in bed at 7:30 every night.
How do you do that?
Because I'm really good at that.
Oh my God.
Yeah.
Like 8:39 maybe.
No, he's in bed at 7:30. He's usually asleep by 7:45. And I woke him up this morning at 7 a.m.
You just like tap dance around the house at night at like 8 o'clock because you have so much time to yourself?
Yeah, everybody goes to bed. My 10-year-old goes to bed. I send everybody to bed.
What time do they wake up?
7.
What are they, bears?
In the morning. No, they're well sleep trained.
Oh my God. All right.
They're well
melatonin. Yeah,
I've never given anybody melatonin, but no, listen, I had 3 kids under 2.5. Like bedtime was a situation in our house. I had to get everybody to bed. And then like now we're in the like, they're so busy, they're tired. Like they're exhausted and they crash. But like 7:15, my son is going to be a
Oh no, I was trying to get my kids in the shower last night and he was like, they were just both running around the house naked. I'm like, you just get in the shower.
Just everybody.
Just get in the shower.
Are you at the like showering by yourself phase yet?
They're like 90% of the way there. You got to like wrap it up because otherwise they love just like sitting under there.
We
like,
have hit to like go upstairs and take a shower. Like I don't have to monitor this in any capacity with the exception of my son. He's the only one that I have to be like, bro, did you like wash all the parts?
Yeah, you gotta stay on him.
But the girls are like, I'm like, go take a shower and they go upstairs. And that's like when a new time in your life begins. When you're not like sitting in the bathroom watching your kid.
Looking forward to that, yeah.
Yeah, it was amazing.
Nice. So what are we talking about today?
So we are talking about the S&P 500. So which I called before we started the salt and pepper 500, like the Daytona 500. But we're talking about, people are always like, you're a new investor and you're like, what do I invest in? What do I do? And if you go online, everything's like the S&P 500. And like, what does S&P even mean?
All right, I guess that's a good start. The S&P 500 stands for Standard & Poor's 500 because it's the 500 largest U.S. companies.
Okay.
That's all it is. So it's all going to be companies you've heard of.
So I want to be standardly poor? Like this is a terrible name.
Standard and Poor.
And poor. I don't want that.
Yeah, I don't know why they have that name, especially in finance. That seems like a bad marketing play. But yeah, it's basically just a mirror of the 500 largest U.S. companies. It's like as simple as it can possibly be.
Does who those 500 companies are change as they change in real life, or are they like always the same ones?
No, and that's kind of like the beauty of the S&P 500 is because it always like kind of clears out the lower end ones and moves higher performing ones. So basically, there's kind of like 3 main categories. There's large cap, which is S&P 500 typically. There's mid cap. So cap is capitalization, basically how big the company is, how much revenue it has, like how much valuation it is. So like outstanding shares times the stock price. Boom, that's the capitalization. Then there's small caps. So sometimes small caps graduate to mid caps and mid caps graduate to the large caps. So some mid caps may move into the S&P 500. So for example, I think 2020 or 2021, Tesla moved into the S&P 500.
Oh,
so
is it like an exciting thing for you as a company when you like make it there?
Well, it's awesome if you can make it there. One of the big reasons is because people are always investing in the S&P 500 index fund. And if you're in the index fund and you haven't been in before, guess who needs to buy all of your stock because you're now in the fund?
Oh, all those people.
Yeah, anyone that holds all that stuff. So that's a big win for a lot of companies because now they're like, they're in the most popular investment on the planet.
So when you're like a consumer and you're like, I'm going to invest in the S&P 500, you are not investing in these 500 companies. You're not buying like one share of 500 companies. You're buying this like one thing.
Yeah. So it's actually it's called market weighted. So so the bigger companies take up a larger portion of the S&P 500. So you don't have like 1% or whatever the math is on, of 500 companies. You may have like one company may take 7% of your overall portfolio because it's that big.
Oh.
Right. But then there might be one that's like 0.004% because it's like the very, very bottom of the S&P 500.
So what stops someone from just having all their investments in this? If this is like 500 bomb.com companies, like why would I not just put all my money here?
Well, that's like the core argument. So there's Vanguard. Have you heard of Vanguard?
Yeah.
Okay. So Vanguard started in the 70s, basically saying like, why would you ever buy a mutual fund? Like just buy the S&P 500, just buy the total market and hang out.
You've got everything. You've got a little bit of everything.
Yeah, because you basically have 500 companies and they're US based companies and they're generally high performers. And it's very simple, right? You just buy this one fund. It's cheap. So like an average mutual fund may cost you 1 to 1.5% per year in management fees just for the mutual fund. This costs like 0.07%.
Okay, like you're selling me on this whole thing.
Yeah, just do it. Well, I'm sure if you looked at your portfolio, which you probably don't look at all the time, I'm sure you own.
I do.
Some S&P 500.
I know that I do.
Okay.
I know that I do. Now, so it sounds to me though, like this for like a new investor.
Yeah.
This is a good. This is a way better idea because we've talked about like a lot of new investors, and I'm going to pick on young gentlemen, who are like, I'm an investor and I invest in Robinhood, or I invest in like they're like throwing money at like what feels like good deals or whatever, but those also have the ability to become bad deals. But this kind of sounds like it doesn't.
For the most part, yeah. So it's basically, I mean, when you kind of like, let's say I'm starting from brand new, no idea investing. I can choose an index fund like an S&P 500 or whatever particular market you want to look at. I can choose an individual stock, or I can do a bond fund or an individual bond, or there's people buying Bitcoin and gold and all the other things. So there's a lot of things you can buy. To me, like the safest thing if you're just starting out is probably the S&P 500. So if that's hey, I want to get going. I want to get something a little bit more diversified than just buying an individual stock. Has a pretty good track record. I mean, over the lifespan of the S&P 500, it's averaged about 10% per year, which is pretty good.
That's nice. That's nice.
Yeah, I don't know if you've heard of the rule of 72, but if you take 72 and divide it by the percentage, so you're in 10% a year, that'll show you how long it takes your money to double.
Oh.
So 72 divided by 10, 7.2 years, your money's going to double every 7.2 years if you're earning 10%.
All of this is sounding really great to me. I'm in for this.
Well, and this is why a lot of the public discourse, whenever you like go on a Reddit forum, or there's a thing called Boggleheads, which is where like Vanguard says like, yeah, cool name, right? Better than Standard & Poor's, but
it's true.
But basically they're saying, hey, just put money in the S&P 500, walk away, don't ever forget about it, right? That's like the only investment you'll ever need.
Okay, so from somebody who's obviously far less knowledgeable about this than you are, is if this is so good, why isn't it the only thing we do?
Well, because people want to beat the market, right? So there's things called active managers. So this is considered a passive management, right? You're just putting money in. They're just buying the 500 companies based on their market value at the time. And then you're putting money in every 2 weeks or month or whatever you're doing.
It's just happening.
And it's just happening. The market goes up 10%. It's gonna exactly mirror that 500 companies, and it's gonna go up 10%. If it goes down 10, it's going down 10. So there's no backstop if it drops. So like 2008, there was one point where it was down from the height 57%. So you got to be like pretty chill with losing more than half your money.
Yeah, I'm not chill.
Yeah, so that's where some people can get hung up. But if you're patient, it rebounded. Obviously, it's doing well. It's done really well the last 15 years, especially. But it's a really good kind of base of your portfolio. That's how I look at it.
So this is like a good this is step one.
Yeah, like in my opinion, look, it's great for all those reasons, right? It's cheap. It's pretty consistent performer over time. If you have a long time horizon, it can make a lot of sense. If you need money in a year or two, or you're approaching retirement, or you are retired, you definitely don't want to have everything in one spot. But I'm gonna switch gears and talk about why some like caveats with just doing that.
That's what I'm hoping for. That was going to be my next question. So let's go there.
Okay, so historically, this isn't always the case, but I did some research here. Have you heard of the lost decade?
It's not. My 20s?
20.
Because that's what it sounds like to me.
No, it's well, it probably actually coincides with your 20s.
Yeah, it's like 2005-ish.
Well, so basically, so in 2000 to 2010, if you invested in the S&P 500 based on January 1st and kept it there for 10 years, you would have pretty much the same exact amount that you put in.
That sounds like my 20s. Okay, great.
Yeah.
Yeah,
Yeah,
that
so
is the lost decade. I like it.
So no growth. And there were a lot of things that outperformed during that time frame, like international stocks, right? So there are actually companies overseas that you can invest in that aren't local here, right? Or gold, for example, or real estate. Like all of these asset classes outperformed over a 10-year period.
Just that one 10-year period?
No, there's some other times like the 70s it did. And, you know, it kind of depends. It goes in cycles, but like the last 15 years has been pro-US, but the last year and change has been, it's been better to be an international. So I think the thing you have to realize is that these things go in cycles. So just sticking with one thing forever doesn't always make sense. It's like never ever changing it. You could be missing out on some opportunities in general, because there's time periods when US will absolutely outperform, and there's time periods when we won't. And sometimes that's a political reason. Sometimes that's just what's going on with our market compared to other ones. Global technology changes, power changes hands. Like there's a lot of factors that go into this stuff.
I'm like contemplating all of this now, because like first you sold it and it sounded amazing. And give
me some of that.
This is great. But then you're like, you could have also wasted 10 years in it and doing nothing.
Yeah.
Is it timeable? Like, can you guess?
Good luck. Well, that's the thing, because that's where active management comes into play, right? So this is a passive thing. So a lot of the argument to say, hey, look, let's just stay in these index funds is that typically in the short time frame, some asset managers can beat it. Usually it's like 40 to 60% depending on the year, which isn't too bad. You got a 50-50 shot of outperforming basically if you've got the right manager. But as the calendar goes on and you're looking at like 10, 15, 20 year time frames, you're looking at like maybe a 1 in 10 chance that you're going to pick the active manager that outperforms a passive fund.
Oh.
However, it does change depending on there's a higher likelihood if you're in a real estate fund that active makes more sense. Bonds typically better to be active. Generally overseas funds tend to do better active. So you can kind of blend it too. Like one thing is like you can do a lot of different things with a portfolio. You don't have to just buy one thing. And I think that's my kind of overall thesis for today, is because we could talk about this all day, but looking at your asset classes, like small caps have outperformed historically since 1929.
Wow.
So they're looking at averaging.
So those are the little companies.
The little guys. Yeah. They did 14.3% since 1926 I have here versus 10.2.
Which is so interesting, because I think when you are talking to people about like, I'm going to buy some stocks, what does everybody talk about? They're like, oh, the Apple and the Google and the Amazon and the big ones.
Yeah.
You feel like those are the big winners, but that's not always the case, is what you're telling me.
No, because I mean, you look at even this year, all those, like they call them the Mag 7, they're all underperforming the S&P right now.
Oh.
All of them together. So like this thing, like 10 years ago, you said like that would have been the best thing if you just bought those 7 companies. You would have blown the S&P out of the water. And just like if in 2000 you bought actually only tech stocks, from 2000 to today, you would have had 1,000% return versus 460% with the S&P. So why wouldn't you just buy tech stocks?
But then from then to now, it could have been the opposite.
Yeah. So, these things go in, like I said, it goes in cycles. There's pros and cons with all of this stuff. The other challenge with just having one fund, like one index fund, the nice thing is, let's say you have an investment account, they're very tax efficient, right? So one challenge with a mutual fund is if I buy a mutual fund in November, I incur the tax liability of that mutual fund for the entire year, even though I've only owned it for like 2 months. And they're always buying and selling stocks or getting dividends. So there's all this tax stuff that's happening throughout the year. You don't typically have that with an index fund. It's very minimal turnover. They're not buying and selling stuff because they're just trying to really match what's going on. And they rebalance only so frequently. But the challenge is, let's say you have that S&P 500 fund and it goes from 100,000 to 600,000, like great return. Okay, now you got to sell it. You're selling everything at a gain, right? It may be a long-term gain, so it could be favorable, but you only have like one lever to pull in general from a tax standpoint when you have one fund.
Can I just make this quick statement for everybody listening? Is one of the things that has been the most interesting to me about doing this podcast is that I think for me, investing always lived in this one like singular bubble, right? You have money, you invest it. I had no idea how deeply integrated taxes are in the money that you're making and investing, and how strategic you have to be to balance the two things. Because you can make a whole lot of money and then lose it all to taxes if you do not do this correctly. And I feel like every time we have these conversations about investments and stuff, it's always like, I don't want to say shocking because that sounds super dramatic, but like it's always just surprising to me that like, oh yeah, no, you can do this great thing, but if you don't think about the taxes, you've lost all the benefit of the great thing.
Yeah, because it's like, think like a bucket with a hole in it. Like a lot of people have investing buckets with holes in them because they're not paying attention to taxes. And like one of the things I always hear all the time is like, oh, I'm earning 4% on my high yield savings account. Great. I'm like, well, you're in the 24% bracket. So every dollar you're earning, you're paying 24 cents to the government on a federal basis. So you're not actually earning 4%, you're earning closer to 3, right? So like you've got to like,
people are doing the wrong, you're doing like the math and then the tax math separately.
Yeah.
And you're not actually
never looking at it,
putting them together.
Yeah. And because when you have like one investment and the market does, let's say it's up and then it drops again, you can't do any tax loss harvesting where that's where you sell something at a loss and offset gains. So like there's no ability to do that after a certain point because the account's just up. And then a market drops. Okay, I'm up $100,000, but now, okay, the market dropped 20%. Now I'm only up $80,000. Okay, well, I can't really do anything with that because I'm still up. I still have gains in my portfolio. So there's some other things you could do. You could do like a direct index fund that mirrors the returns of an S&P 500, and it actually buys the individual stocks for you. So you can sell
individual
Coca-Cola this year because they were down, but you still have 95% of the portfolio still intact. And then you buy that one fund back in 30 days. Because you were to, let's say, sell a tax loss harvest and S&P 500 index fund, you have to be out of that fund for 30 days.
Before you can go back in again.
Before you go back in. So you lose some tax flexibility when you only have one investment.
All right. So I'm getting some of the, I don't want to say negatives, but like it isn't all right. When we first started, I was like roses and sunshine. Yes, give me this thing. But you have to think about the full picture.
Right. Well, it's nice because it's simple. But sometimes the downside is it's simple. And when you have... you're driving a little dinghy around, you got a little tiny boat and you don't have a big account, like it doesn't matter. But as we age, we typically get more complicated finances. And now we're maybe riding around in a yacht and like, hey, we got to have a crew here to kind of manage this thing, right? It's a bigger undertaking and there's a lot more nuance involved as your accounts grow.
Now, is one of the nice things about it the fact that in itself, it's diversified because it is all of these companies. They're not all, right? Some of those companies are tech. Some of those companies are real estate. Some of those companies, like, is that a helpful part of it that while the market is kind of rolling with all of the differences in these type of stocks, you're, I don't want to say buffered a little bit, but you've got a little bit of all of it. You
are. And that's actually a great question. But historically, the largest 10 companies made up about like around 20% of the S&P 500. That's have crept up tremendously. Now it's like 35 to 40% is just 10 companies.
Oh, wow.
So a lot of people think they're really diversified when for every dollar you're putting in there, 40 cents is now just going to 10 companies. So we're definitely not as diversified as we used to be.
Or as it sounds, truthfully. When you tell me 500, that sounds really diversified. And again, I think in my brain, I would just assume it was like an equal split of these companies. And it's not.
Well, think about it. So 40 cents is going for every dollar to 10 companies. That means 60 cents is going to 490 companies.
Yeah, that's
a very small chunk of the pie.
Yeah.
That's going to these companies. So that's also one thing to consider is like how diversified are you really in general with this stuff? And that's one of the things as you start building a portfolio out and you're saying, okay, well, maybe I'll buy a tech stock on top of that, or maybe I'll buy this on top of that. Now you might be buying Apple 4 different times.
Oh my God, I never would have thought about that.
Right. It's like, and a lot of people think they're diversified, but like they're buying vanilla ice cream and buying vanilla bean ice cream. Like, okay, I guess technically they're different.
But they're doing the same thing.
They're very similar, right? So that's something you want to look at when kind of creating a portfolio for yourself and thinking about, okay, well, because real diversification happens when you have things that interact differently in different markets. Right. So if we're using ice cream, for example, you're going to buy more ice cream in the summertime, right? Mm-hmm. So like maybe large caps go up in the summertime when the market's really good. But in downturns when it's cold, maybe you want to sell hot chocolate now because now people are going to buy more hot chocolate in the wintertime versus the summertime. So that's how like they interact. Like that's how having different types of asset classes can really help a portfolio. You may lose some upside, but you're typically going to lose less too, which can be important, especially as you age and get closer to retirement.
I'd like to tell you that whole analogy should go in your next book.
It's in the book already.
Oh, good. Okay, great.
But yeah, just retire already for those folks that shameless plug.
It's a great book.
Yeah. But yeah, those are some of the things I would look at. And then I just kind of looked at, the other thing is like just general risk, like profile of it. Being in one stock can be really risky. Like we mentioned the 57% drawdown. Like at what point are you not freaking out?
I'm freaking out already. Like you've mentioned it in my lost decade of my life. And yeah.
But it's like, the thing is we have to get behavior. Like and every time there's a market correction or it's down 10%. I mean, even now what's happening with Iran is you're going to get questions from people. And I generally can talk them out of it. Even last year, I was able to talk a lot of people out of it. But if you're left to your own devices and you are that person that freaks out when the market drops 10 or 20%, because hey, if you have $1 million and it drops 20%, that's $200,000 you lost.
Yeah, you're crying.
You're not feeling great about it. And you may say, hey, look, I'm close to retirement. I got to pull this money out of here. I got to do something else. I've got to go to cash. And unfortunately, the best days almost always follow the worst days in the market. And people end up hurting themselves because the average investor actually has returned closer to something like 3% a year.
Yeah. Well, and I think the panic, that like panicky feeling. So for full disclosure, for those of you who don't know, today, as we're recording, the bond is struggling today.
Yeah.
Very, very hard. And for interest rates, we have been on this like 2-week mortgage rate roller coaster where we're like, oh, okay, they went down really far today. So when I say down, the bond went down, which means rates went up. It went down really far today.
Yeah.
So it's not going to open like that tomorrow. And then we open and we're like, oh,
it's getting worse.
Okay, it's getting worse. And then today has been a real doozy. We were like crying by 9:30. But if you get like caught in that, and I think even as like loan officers or clients are like, well, just lock me. And I'm like, you don't want to lock this is the day you don't want to do it.
Oh, yeah.
Even if tomorrow is worse, it's not gonna, the rates are not gonna be as volatile.
Right.
And I think that's the thing that people miss in investing sometimes too, is that like when things are at their worst, that's when you don't touch it. You just let it settle.
Don't even look at it at that point.
Yeah.
Because you really want to invest on your time horizon anyway. Like that. Well, number one is like, what is the purpose of this account? And that should always align with it. Because if you're retired, you should have enough cash to weather a market downturn that's 20% or so. And no, okay, I've got the buffer there for that. And then I also need to beat inflation. So I should have some money that's still invested to combat that. But that's where having a real mix of your portfolio can really help. And I think we're probably in another cycle where we're probably moving out of the S&P 500 because the S&P 500 for 15 years was the best place to be at. Like if you put it in there, and I'm showing you, and this is what's killing me as a financial advisor because we always have these diverse portfolios, and you're like, we're lagging S&P again this year, and you're lagging it again. And I'm like, no, trust me, it's going to turn around. And we just look stupid for 15 years. But last year we saw really where diversification came in because Europe outperformed, because emerging markets outperformed the S&P 500. So we may be in another cycle, especially with everything happening kind of politically with a new change in world order. It seems like this could be a better time because European stocks are much cheaper than US ones.
So this is where, and I think the other thing too is, and this is the prediction piece we talk a lot about, like, and I say this for mortgage rates, like people are like, what do you think rates are going to do? If I knew that information, I would be Warren Buffett,
right,
who I think is somehow controlling all of this. I don't know. Like we can't know the answer to that. You can only look at the data that you have available right now. And like what we know about the world right now looks very different than what we knew about the world on this day 1 year ago.
Well, look, even 2 years ago, we didn't know who was going to be president. We didn't know there was going to be a war in Iran in 2 years, or conflict, whatever you want to call it, right? You had no idea. It was not when I was reviewing accounts with clients, I was not thinking, well, in 2 years we might have this conflict in Iran.
Yeah.
Wasn't on my radar. And it's hard to anticipate this stuff in general.
So you just have to almost anticipate for everything, for the good and the bad, and make sure that the way that you're invested works in either scenario.
Yeah, because one of the things I looked at just for funsies was, okay, what if I had an all equity but diverse portfolio? So some international, some large and small cap, some mid cap, some real estate compared to just the S&P 500. And one of the things I looked at was how did it do in 2008? Right. And they both did terrible. And actually the diverse portfolio honestly did a little worse, which I thought was would have been not what I guessed. Right. I would have guessed it would have been not as bad. But what was interesting, it did recover faster.
Oh.
Right. So that's some of the things is like how much of a dip do you see and how much does it recover? And a lot of that stuff, because that matters too. But I'm generally a big fan of like trying not to lose as much because it's generally harder to recover for something. So if you lose, if you're down 10%, it takes 11% to get back to where you were.
Yeah.
Yeah. So I think it's really about being, having a core portfolio. I'm a big fan if I'm designing portfolios or looking at it, like the core should be the S&P 500. It's the most consistent one. It's going to beat most active managers. Most advisors aren't going to outbeat it anyway. And they're like doing things in their little back office in the basement, right? They're not going to outbeat them for the most part. And then you just build around that based on what your time frame is, what your goals are for the account, how much risk you want to take on. Because you're the type of person that sees an account go down and is going to react to it, then you should not be in all in equities, and specifically all in one investment.
That's me.
Yeah. So, or you just don't ever look at it.
I just don't look at it. So we sort of started this conversation with the thought of like, this is what if you are Googling, like, I'm a new investor, I'm a first-time investor, where do I put my money? S&P is what kind of always shows up. So truly, I guess, what is your advice? If you're a brand new investor, I have this money, what do I do with it? Is this where you should be putting it? Or is this, again, where you need to be diversifying it?
I would still look to diversify it. And the nice thing now, like versus 25 years ago when it was so hard to buy these things or so expensive to buy them, you could buy everything now so cheaply. So you don't need $10,000 to start investing in even a diverse portfolio. So you could still buy the S&P 500 and you could buy international stocks and you could buy some small and mid caps and you could buy some bonds and you could do all of that with like $100.
100. So there's no, because people ask me this question all the time, because because again, I'm on the mortgage side, so I'm looking at people's bank accounts and I cry regularly because people will send me their checking account with $80,000 in it and their savings account with $200,000 in it. And I'm like, first off, danger zone. Like, this is how you get your money stolen. But also it's not doing anything. And I'll say to them like, hey, once we finish this transaction, you really should not leave this money in your account. And they're like, oh, it's not enough to like invest. It's just my savings. I don't want to put it somewhere where I can't get it, or I don't want to, because people always think CDs, that's actually where people go with me a lot, is they're well, I don't want it to be tied up in a CD. And I'm like, there's like a million, I've never had a CD in my life. Like there's a million other places to put your money. But if you're telling me like $100, like what is if you've got an extra $100 laying around, like, should we be investing it?
Yeah. If you don't need it, I always have this like, waterfall or champagne tower thing. Like once you have your emergency fund set up, and my general rule of thumb is if you're going to need something, let's say it's a down payment on a house, that should be mainly cash if it's like a 2-year or less time frame. Because generally it takes 20 months for a 20% drop to recover on average. So it gives you that time to do it. I just would never want to have someone be like, hey, I saved $100,000 for this down payment on a house. And then something like this happens with, whatever that's out of our control. Even Liberation Day last year when the market went down 20% almost in a month.
Yeah. 20 grand when you're buying a house makes a big difference.
Yeah. So if your down payment is 100 versus 80, you don't want to mess with it. It's for you to earn an extra potentially 5% or maybe even 10, like, it's not going to change your world. Right. So if it's outside of that area, that's when you want to start looking at investing. Because at a certain point you need that money to work, because you got to beat inflation. Because, the thing about CDs or bonds, so now you've got the tax problem, but then if inflation's 3% and you're earning 3%, you're earning nothing.
Yeah. Your money's just chilling.
It is just, it's growing. It looks like it's growing, but there's that phantom thing called inflation that is just eating and eroding your money away.
Well, and at that point, like, put the money under your mattress. Not really. Mortgage people hate that, but like, put the money under your mattress, because it's doing the exact same thing. And I think that's the conversation that I have with people a lot. And I tend to find it's a lot of like young adults in their 20s and 30s that have good savings. Their version of investing is their 401k.
Yeah.
It's really the only place that, and even that, like I've said to people, like, you can put more money in there if you wanted to.
Yeah.
Oh, well, it's getting taken out of my paycheck. I know that, but you're not hitting your
you're not maxing out. You can increase it.
Yeah, you can put more money in there and at least have that. But people just think like, oh, if you don't have $200,000 or $500,000 or $1 million, you're not worthy of investing, or it's not going to make a difference if I invest it. Yeah. But it very much can. Yeah,
I mean, this is where like, hey, Gen Z, this is like one cool thing that you have that we didn't really even have growing up, is when we were 20, like it was very hard to buy fractional shares. So I don't know exactly what like an S&P 500 index fund costs, but usually it's like $500 or $600 for like one share of an S&P 500. But now you could buy what's called a fractional share. So you're not buying the whole share, but if you're putting $30 in there, it'll buy $30 worth of that thing. So you can create a whole portfolio with $100 if you could buy these fractional shares.
This is like, there's going to be way more millionaires. Not that a millionaire means a whole lot these days, but like there's going to be way more people generating wealth off of investing, I think, at a younger age than there was even in the last 10 years.
Well, I'd say two things. The barrier to entry is so much lower than it was even 10 years ago.
You couldn't talk to a financial advisor if you didn't have at least 100 grand of cash to hand them. When I started in mortgages, and I would meet with financial advisors and I'd be like, do you have a minimum? And they'd be like, oh, $250,000, $300,000. And that's why people think they can't invest with less than that. But that's not it anymore.
Right. Well, the other thing, when I first started, your only other option was if you had a low amount of money was putting money in a mutual fund. And a lot of them have what's called A shares, where you have to have an upfront cover charge, basically, getting in the club. Hey, just to invest with us, we got to pay you. And a lot of times it's 5.75% that you're paying just to get in there before you even start investing. So now you're starting a race half a lap behind, and you're paying an annual fee. So the fact that you could buy an ETF now with no upfront cost, no cover charge, you can buy a fraction of a share and you can put money in and it's $30, and you can do it consistently every week or every month. There's almost no excuse now not to be able to save and create a portfolio that's good for you.
Gen Z,
you got some, look, I know that you got a lot of challenges. I'm just saying there's a lot of things that you have going for you that other generations definitely did not have.
Correct. Better wardrobes and better music, but that's another story.
Oh, yeah. But there's an advisor in my office who was telling me when they first started in the 80s, people were paying 9% for a mutual fund because they were glad to pay it.
They were happy to have
How do I get this? Yeah.
But you didn't do those things until you were old and rich in the 80s though. That was the difference too, is you were old and I feel investing in the 80s was a lot of I got all this money, I don't really know what to do with it. I don't really know what to do with it was how it ended up invested.
Well, yeah, or you just put it in a bank because I don't know. We had this little passbook thing when I was a little kid. It was every time you had money, we'll just put it in a bank. I mean, it was earning 5 or 6%, which didn't suck. But I mean, if my parents put all that money into stock when I was 10,
I'd be
doing all right.
You'd be doing all right. All right. All right. Well, I think this was helpful. And I think from the, standpoint of if you are new to investing, or there's a lot of people who think that they're investing because they have retirement accounts.
Yeah.
But there's more to it than that.
Well, I ran into someone today that had money in a retirement account, but they didn't invest it.
So can you do that? It's just sitting there
in cash. Yeah. So it may sit in a money market fund. You have to, if you're managing stuff yourself, this is one thing, because I run into this all the time. It's 4 or 5 times a year easily. They'll put money into a retirement account, like a Roth IRA or a traditional IRA, and it just sits there in cash. It may earn 2 or 3%, and you got to invest it. So if you're a quote unquote do it yourselfer, do it part.
You got to do the whole thing.
Yeah, cool. You rolled something over. You got to make sure it's invested.
Wow, that kind of blows my mind.
Yeah, it happens. It happens very frequently. I've ran into it, I think 3 times already this year.
But this is the old, the people always think they know better than the people who actually do their job. Yeah. And it's it's not that hard. I get that in real estate. I don't need a realtor. It's not that hard. I can go be my own loan officer online. It's not that hard. It's not, guys, we to have education. We have training. Yeah. We read up on this. There's a lot that goes into all of these sort of professional professions. And I don't know, my money is not the thing that I would be playing fast and dirty with.
Yeah, I get it. There's some people out there that are really into this and really love learning about it, and that's cool. And honestly, a lot of times I run into their stuff and it's generally okay. I mean, I could generally point out 1 or 2 things that they probably can do to improve their situation, but there's a lot of people that just don't care. They don't look at this enough, or they're too busy. There's a point where people just get too busy. You have kids, your jobs. You're 45 years old now. You're a high-powered executive.
You're sitting outside in a cold, wet field watching baseball.
Yeah, yeah. You're not also checking your Vanguard account.
Yeah, right? But that's why you hire people like you.
Yeah. But anyway, moral of the story is S&P 500, great investment. Shouldn't be your only thing. That's probably my main takeaway.
I like it. That's the little soundbite for today.
Yep.
Awesome. Thanks, everyone.
All right. Bye.